great to see you back, our viewer. We appreciate your continuity to gather information, and welcome back to N-Wealth Conversation, hosted here on N-Wealth Money TV. Of course, we continue with the conversations around money. Today, we are concentrating on investment matters, and we are asking ourselves, is it really a good time to invest, and where are people getting money? I have a guest in studio. Her name is Dorothy Gacheri, a great portfolio manager and collective investor. She's dealt with individual investors like you. She's walked the journey with people, and so she best suits to respond to all our questions. Karibu, Dorothy.
Asante sana.
Maybe just tell our viewer, maybe I may have not used the correct words to describe you. You want to take that opportunity?
Yes. Why not? So morning, everyone. My name is Dorothy Gacheri, a portfolio manager with Gen Africa Asset Managers. Gen Africa is one of the leading investment firm in Kenya. We deal with investment management for pension schemes and individuals as well. In terms of myself, I am a financial analyst certified by SIFA, and I'm happy to be here. Asante sana.
Thank you. So maybe to start us off, assuming the person just seated at the other side of this video is asking themselves if they were to walk to your office for you to construct a portfolio for them, what are the stages and what are you looking at as you balance their portfolio?
Okay. I think the first and foremost is when it comes to investments, we have to look at it like going to a doctor, whereby before the doctor prescribes the medicine, then of course they have to understand what exactly you're looking for in terms of your goals. Are they short-term goals? Are they medium-term goals? Are they long-term goals? Then after that, you have to also understand the risk appetite for the person. And then after that, now you can prescribe in terms of where really to put in the shilling. So that will be the first stage. Just again, understanding the client, what are the investment goals they're looking at, and what is their risk appetite, what is the liquidity again that they're looking into. Then after that, we can be able now to put the money into different pots that we have. So in terms of the different pots, really, we normally say, we can't say less about diversification. You have to diversify your portfolio. You have to ensure that, of course, you diversify in line with your goals. If it's a short-term goal, then you get to know where exactly do I put in the money. If it's a long-term goal, exactly know which bucket to put in the money. There are many asset classes that you can invest in as an individual. You just have to ensure that you understand the asset that you are investing your money into. What are the kind of risks that that asset class, of course, has? Because not every investment has a risk. I know we normally like talking of fixed income to be a guaranteed asset class, but again, it has its risk that you have to understand. And again, when I say fixed income, what I mean is buying a government bond, buying a government treasury bill, or even just putting money in the bank. That also has its own risk that you should be able to understand. Of course, you can do property. I know as Africans, as Kenyans, there's something about soil. We love so much about buying land, but again, it carries a lot of risk. And you need to understand, again, what risk are you putting yourself into? In terms of liquidity, will I be able to convert this asset class quickly in case of any emergency or in case of any liquidity arise? So in a nutshell, what am I saying? That as much as yes, would like to do all this as an individual, you need a financial advisor. You need someone to take you through the different asset classes, the different risk classes these asset classes carry, and of course the return that, of course, that again we are also expecting from these asset classes, and the liquidity profile for these asset classes, so that when you invest in the money in any asset class, then you are at least comfortable that this is what I'm looking at. And again, just make sure that you diversify. Ensure that you're not putting all your eggs in one basket. Yes.
Good. Now, you've talked about the risks, you've talked about the goals, and you've talked about the liquidity and all that. So for somebody who don't know their risk appetite, I mean, maybe just elaborate. Correct. If I wanted to gauge my risk appetite, how do I do that?
Very, very good question. So how would I know as Dorothy what is my risk appetite? So one, there are questionnaires that we normally give to just guide you on how to rate your risk. In risk, really, we need to look at it in a two-way. One, ability, and one, capacity. Because, I mean, I think the first question we should have asked ourselves is, what is risk?
Yes.
In the first place. Risk is the uncertainty that whatever return that was be expecting from an asset class will not actualize.
Yes.
So you must be able to gauge your risk as a person. As I'd said before, a questionnaire will help you, but it will be very subjective.
Yes.
So a questionnaire will help you in terms of the ability for you to take risk. But you also have to gauge at it at capacity. Am I able, in case I buy Safaricom as a share, for example, and the price drops to 40 shillings,
Yes.
and I bought it, let's say, at 50 shillings, am I able to take the 10 shilling loss without it disrupting in terms of my financial ability?
Yes.
So that's how we normally gauge risk. So we'll give you a questionnaire that will help you. But again, when I look at your asset class, in terms of your asset capability,
Yes.
your financial capability, I'll be able then to know exactly where to place you in terms of risk. Are you risk averse? Are you moderately risk person? Or are you an aggressive risk appetite?
So in short, you're saying, are you willing and able to lose money just in case something happens?
Correct. Yes.
Talk about risk in respect to age.
Good. So risk is very subjective, as I'd already talked about it, and age is a big factor when it comes to investments and risk. Again, there'll be outliers, and I'll be talking about them, but normally as you age, your risk appetite should begin to start coming off a little bit or lower. What do I mean? When you are young, of course, you have the years to, in case you make mistakes in terms of investments, you have the time to correct those mistakes in terms of investments.
Yes.
But as you get older now, you don't have the time to correct in case of a mistake in terms
Yes.
of investments. So we normally say that as you age, then of course your risk capacity or ability should come off a little lower. In fact, what normally, again, by the book, it says that if you want to know how much of your portfolio you can put in aggressive assets, that is the risky assets, just take 100 minus your age. So let's say if you are 60 years, 100 minus 60, that means 40% of your portfolio should be in risky assets. If you are younger, 20, 100 minus 20, it means 80% of your portfolio should be in risky assets. Yes.
Wow, I like that. You've also talked about liquidity as part of the factors that you're considering when you're constructing your portfolio.
Yes.
Maybe you just talk about it a little bit more. So, how do I then decide an asset class that is going to meet my liquidity needs? And maybe for somebody who doesn't understand what liquidity needs are.
Okay. So to begin with, liquidity means the ease at which you can convert your investment into cash. So if you look at assets like a cash deposit in a bank, that's the most liquid asset class. Why? You can just walk into a bank and withdraw your money. When you look at an asset class like property, it's the most liquid in terms of asset class. Why? For you to get a buyer, I mean, between me and you, we both know right now, if I wanted to sell a land somewhere, it will take time before I get a buyer for that land. So what you need to think about in terms of liquidity is again two ways. My own personal liquidity needs or cash flows. How much do I want or how much is expected from my portfolio in the next 3 or 4 years on an annual basis? Then now after that, you think about liquidity of the asset class. So that means if I require money in the next 1 year, so that means that that portion that is required for the next 1 year, I'll put it in a almost cash or equal cash. By cash, I mean fixed deposits. These are deposits by the bank. Unit trust, the collective investment vehicles. You can be able to just withdraw the money at any point that you want your money. Then again, if I want to build a house, let's say for example, in the next 5 years, it means that I have a 5-year investment horizon, and I can be able to go to the illiquid assets that will normally give you a higher return compared to the cash and equivalent as cash asset classes. So you need to balance the two. What exactly am I looking at in terms of my cash needs? And number two, the asset class, how liquid is it? Because again, every asset class has different levels of liquidity.
Yes.
Yeah, when you talk about equities, then of course we call those ones liquid.
Yes.
Because you can just go to the stock exchange and sell the share.
Yes.
If you talk about a government bond, again, we can call it medium to high illiquidity. Because again, given the macroeconomic environment, selling a bond might not be easy.
Yes.
So those are the factors that you really need to put in place before you put any money in investments.
Wow. Thank you. Again, I go back to my question. Do liquidity needs change with age?
Yes, they do. Why? As you age, of course, cash flow becomes a key requirement. We've seen cases whereby we have people who are property rich or asset rich, but cash flow poor. And as you age, you need more of the cash flow compared to even the assets that you've accumulated over the year.
Yes.
So what are we saying? As you go by in your life, before you go into retirement, then it means that what you need to focus on is, can I reduce part of the assets that I've invested in illiquid assets and convert them into assets that can be able to give me cash flow?
Yes.
Because when you retire and at that point, cash flow becomes very important compared to even the assets that you'll have accumulated over the years. So yes, as you age, of course, liquidity needs continue to build up. Again, remember when you are young, of course, you have other sources of income that can be able to give you cash flow and meet your requirements. And that means you can be able to lock most of your savings into illiquid assets.
Wow. Well, thank you. I think now we've looked at those three. Now, tell me, as I'm setting my investment goals, are there key questions that I need to answer? Yeah.
Correct. So the key three things that you need to look at when you're setting your investment goals is, what is your return expectation? That is number one. What am I looking at? Am I looking at to get 10% return and I'll be comfortable? Am I looking at getting 20% return and I'll be comfortable? Or am I looking, what is your return expectation? Or do I want to just beat inflation and get real profit? So that's number one key thing that you need to look at.
Yes.
Number two key thing that you need to look at is your risk appetite. Because remember, again, the higher the return, the higher the risk.
Yes.
So you can't have a 20% return expectation and you don't want to take risk, because high return, high risk. So you need to balance the two. You have to do what we call optimizing returns vis-a-vis maximizing return. Because I mean, so many people will want to maximize. But maximizing means that you get any return irrespective of the risk. Optimizing should be the case, whereby we are saying, yes, get a good return, but also ensure that the risk that you're putting into that asset class is not so high. Because it means if the risk is too high, then of course the chances of losing money become very high. The other thing is, of course, your liquidity. So three things. One, you should look at your return expectation, your risk expectation, not even expectation really, but what is your risk appetite and capability? And number three, what is your liquidity profile? Both from your end and both from the asset class. Once you have those three things set, then you'll be able to get to know where exactly do I want to invest in.
Wow.
Yes.
Thank you. Thank you. Thank you very much, our viewers. I know you've picked a lot of investment nuggets and you're going to take action. Kindly remember to like the video, share it within your circle so that we benefit all, and drop a comment at the comment section so that we follow up. But we appreciate you until we see you in the next episode.